Hello, good afternoon. We've got a shorter week in trading, but still quite a bit to dissect. And our question of the week is yet again, of course, we have even more legislation to consider just in time for year end and moving into 2023. So we're going to cover the Secure Act 2.0 and what is now official from what started, some months ago. As a quick reminder, this is a shorter week. We've got the markets were closed on Monday. We have another shorter week next week with markets closed on Monday again for Christmas holiday and for New Year's. So I hope everybody's having a great holiday season. I hope you're able to enjoy Christmas weekend and wishing you all a very happy New Year. My name is Brandon Steele, financial advisor with Mainsail Financial Group here in Bellevue. And our goal every Thursday is to bring to you the market news and data and trends we're watching and hopefully weed out a bit of the noise along the way. So again, here we are on a shorter trading week, 4 days here this week. We'll have the same thing next week, but still quite a bit to cover. Let's go back to last Friday, which I think is where some of the data really started to show. So last Friday, we had PCE index numbers come out. So in other words, another measurement of inflation. For the most part, this was in line with expectations, which is interesting because as of late, it's been a little bit below what the expectations were going into these print numbers, but basically in line with expectations. That said, what I thought was really interesting is the year over year core PCE number was actually higher than expected. So I wouldn't write home about this. This isn't something to look into too deeply, but it is important because obviously the Fed is a big factor. Here we are moving into 2023, where I think they're still going to dictate some markets to some degree. And obviously, as we get this data rolling out, it's going to factor into what the market speculates on, which you've heard me talk about many a times, heading into the February meeting. So keep a close eye on some of the inflation data coming out. Again, I would be very cautious of getting too wrapped up into every data point because the Fed has been very clear on their path. They have gone down their path. And so if we, just like the last 6 months, every time the market gets excited about the Fed slowing and the Fed says we're not slowing. So keep that in mind, especially with a higher still year over year inflation data point than many had expected. So that was last Friday. We also had spending up barely, just up 0.1%. So not a whole lot to dissect there. But what I thought was really interesting is here we are the week between the holidays. Typically, as I mentioned last week, this is a slower week in trading, but we've got 2 days between yesterday and today on Thursday of pretty big market movements. So yesterday, Wednesday, basically we had a big pullback as the US announced travel restrictions from China. So it was really interesting because this was kind of that first scare in a while for COVID impacts to the market, right? We haven't seen that really drive anything for a very long time, and all the focus has been on the Fed, as you know. So really interesting to see that. It's funny, as I was preparing for this yesterday, I was going to share that it's very likely that this is short-lived and more of a headline kind of, news story that kind of led to a market pullback than anything else. Here we are on Thursday and the markets are up big. So I think that's very likely short-lived. Even today, actually, it's funny, a lot of the other countries have come out and shared the same type of restrictions for travelers from China. So even though this is probably going to continue to be something that's in the headlines, clearly it was more of a knee-jerk reaction, I think, in the markets yesterday. And then again, fast forward to today on Thursday, markets are up pretty strong. We will see what happens tomorrow. I'm hesitant to say this with what's gone on the last 2 weeks, but typically this Friday heading into the new year is a bit of a slower day as far as volume and trading and all that good stuff because people are already looking into 2023. So keep that in mind, but let's all hope that 2023 brings a little more opportunity. It's I think a very different environment than it has been in the past 10 years or so. So as you look into next year, you want to think about what may work in this new economic environment that we're in that we really haven't seen for a long time with recession scares with interest rates and inflation and you name it. So that'll be something maybe we'll cover as we move into 2023 as well. The biggest thing I wanted to cover before we move into what's coming up next week is to cover a question of the week, which is awesome. It's about the Secure Act 2.0. You may remember we covered this back in, I think it was April, believe it or not, of 2022. That's back when the House had originally passed it. The Senate passed a different version, and they just never came together. For those who follow us really closely, I had shared a ways back that as we knew that the House and Congress, that Congress would be split in 2023, it was very likely the Secure Act and some sort of bill went through this year as kind of that final win, so to speak. And here we are. So the Secure Act 2.0 has officially passed. And there's a few things I want to touch on a high level to consider with this new legislation. The first, and maybe the biggest, well, that's not true, but the first is that required minimum distributions have been pushed back again. So for those, and if you're already taking them, you're going to be subject to those same distributions. But for those who have not started being required to take money out of your 401ks and IRAs, that RMD age is what it's called, required minimum distribution, was pushed back to age 75 by 2032. So it's a bit of a sliding scale, but by 2032, it will be age 75, unless, of course, more legislation passes, which is more likely. Let's see here. We have reduced RMD penalties. So typically the penalty if you miss an RMD is 50%. That's actually decreasing quite a bit next year. Still not something you want to pay or miss if you can avoid it, but it is a little less steep moving into this new legislation. One of the other biggest ones, I mentioned the RMD, the other biggest one is that employers are now allowed to do Roth contributions on your behalf or on the employer behalf. So for matching or whatever it might be, employers are going to be allowed to contribute on the Roth side of the 401k if you have that available and if your employer makes it available. So this is exciting. What it does mean, however, is that contribution would be taxable to you, whereas right now it is not. So on the pre-tax side. So it's something to really weigh, and especially if your employer offers this moving into the next year or the year after, definitely want to take a look at that and consider the impacts for setting up those contributions on the Roth. There are also increased catch-up contributions on IRAs and 401ks, and the IRA actually is now, the catch-up contribution for those 50 and older is now actually tied to the cost of living adjustment. So we may see that raise over time, especially in a period of inflation. Lastly, matches to 401ks are now allowed based on qualified student loan payments. So in other words, somebody who maybe cannot do the student loan payments and a 401k contribution, if you can only pay for student loan payments, for a qualified student loan payment, now your 401k may allow a match against those payments, right? So, most of our clients are able to kind of do both, but generally speaking, if you're not, this is a great opportunity because this may allow you to get a little bit in an investment vehicle where maybe typically you wouldn't be able to do so. And again, employer has to allow for this too, so keep that in mind. So very high level today. There's a lot more to this bill, by the way, but I just wanted to touch on some of the top, I think that's 5 points in the Secure Act 2.0 to consider moving into the new year. Pay attention to what your employer offers and what this shapes up to be in the next year. And we will see you coming up in 2023. I don't know how I'm saying that already, but remember, we have a bit of a shorter week. We've got Monday, the markets are closed for New Year's holiday. And then we get right into a very busy week with Jobs Week coming up next week. So we'll see you next Thursday for the first weekly update of 2023, where we will be breaking down and anticipating some of the jobs data that comes out next week. Have a great, happy new year, and we will see you next Thursday at 3 p.m.